Now, company earnings are quite important when you want to know if the company you want to invest in is a good company or not. These are the companies, or these are the earnings that tells you how the company is performing financially, which is something that is very important because, of course, you want to invest, or ideally you want to invest in a company that is doing well financially, or in other words, that is seeing maybe its revenue growing each and every time they report their earnings. So these becomes very important, or it is very important as a retail investor, that when you want to buy a company, before you even put or you press that buy button, you go and have a look at how is that company performing financially. Now with that, you will know that of course there are many things that you will need to look out for, but in this video today I just want to give you the three most important things that obviously you need to look when you open or when you have a look at the company's earnings or financials results, which is very important. Now before we go any further, you already know that this video is just an entertainment video and not a professional financial advice video. Now I really appreciate if you can just hit that like button if you do enjoy the content that I'll be giving you about the three main things which I personally believe you need to look out for when you are investing into the companies, or before you hit that buy button and buy shares in the company that you believe that it's a good company to put your money in. The first thing that you obviously want to look at when you buy or when you are analyzing a company, it is to check obviously if its revenues have been increasing. Now this is very important. You need to check the revenues of the companies you are investing in. Has the revenues been increasing over time, or has the revenues increased in their recent financial statements or quarterly earnings? And if not, why did the revenues not increase when comparing to the previous quarters? I mean, it does happen. I mean, in 2022, due to high inflation, interest rate hikes, we saw of course companies reporting poor earnings, meaning that the revenues that obviously they were reporting before inflation or before the Federal Reserve started increasing interest rates, they were not beating those revenues, or they were not beating those earnings, meaning that obviously due to the fact that interest rates have been increasing, or central banks were increasing interest rates aggressively last year, it led into obviously businesses not reporting good earnings, which then meant that it was not because those companies were not good companies, but it was because of the current economic conditions. So it is obviously important that you don't just say because this company this quarter didn't report good earnings, then it is not, or it is therefore not a good company, but rather you check what's happening around, especially in the companies within its segment or within its industry, which is very important. So revenues are very important, but ideally under normal circumstances you would want to invest in a company whose revenues continue to increase, or whose revenues continue to grow when comparing to the previous quarters, previous years, which obviously that will definitely mean, or that means that the products and services that that company is producing or providing are growing, and chances are they are going to continue growing in the future, which is why revenues are very important. Now the second thing that you would want to have a look at before you press that buy button is the earnings per share, or the profitability of a company. This is very important because ideally you would want to invest in a company whose profits continue to grow. In terms of profitability, or in terms of the earnings per share, it continue growing or positively increasing, which is something that is good, right? And for those companies that are not yet profitable, one of the most important things that you need to check is how close are they becoming, or are they getting to reach that profitability status. That is also important. So this EPS ideally tells you how profitable a company or an organization is. So as an investor, before you buy or you press that buy button, it's important that obviously for both profitable and unprofitable companies, you go and have a look at this key term and check how is this company reporting better EPS, earnings per share, when comparing to the previous quarters, previous years. Then if it is, then probably that is a good sign, or it is a good thing. But again, I will take you what I just said about the revenues. You also need to check, if not, you would need to check how are the economic conditions, because once again we saw a lot of companies back in 2022 not doing well, even when we saw, or when we check their earnings per share or the profitability side of the business, because of the current economic condition. Rising interest rates hurt a lot of companies, and we know that chances are we are still going to see the Federal Reserve Central Bank increasing interest rates this year, trying to curb inflation or the cost of living, which, guess what that's going to do? It might continue to hurting some of the companies, because the economy worldwide is not, or in most countries, it's not stable due to high inflation. So we can it is expected that in the times that we are in, companies don't perform well in terms of the revenue they generate. Companies don't perform well in terms of the earnings per share or the profitability every time they report their earnings. But this does not mean that you must not check this thing. It is important that you check, so that at least you have a feeling of how the company is performing, and go and compare the company, and go compare that company you want to buy against its peers or companies in its industry, which is very important, which takes me to point number 3. Before you buy a company, it is very important for you to check how overvalued or undervalued that stock is comparing to its peers. This is very important, guys, because sometimes, I mean, I've seen a couple of people or number of people buying stocks which are seriously overvalued when comparing to their peers, which is very dangerous, because chances of you, of course, maybe making a lot of money from those stocks, you find that it are slim. Yes, you find that there are those kind of special stocks, or we have got a special cases where companies continue growing or continue to see its share price rising, though maybe it's overvalued when comparing to the companies or in its industry or its peers. But it is important that you go and obviously check out how overvalued or undervalued the stock you want to buy is when comparing to its peers. Now you might be asking yourselves, how do I check this? Now, for companies that are profitable, obviously you can go and use a key term which is called the P/E ratio. I mean, this is a key term that in most cases, in fact almost all companies, you can just go Google and say maybe so and so share price, SoFi Technologies share price, Neo share price, Sibanya Stillwater share price, Purple Group share price. You are going to get this PE ratio. Then what you need to do obviously is to go and compare this company against companies in its industry. For the US company, Google has made this job really simple, because if you can just go and maybe just say Neo share price, and if you have a look at the tabs, you will notice that there is a button that says compare. Well, the moment you start clicking, or you click that compare tab, it will show you, or it will bring some of the companies that are in its industries, and it also break down some of these things for you. Yes, Neo is not a profitable company, so you will not see a PE ratio there, but it will show you how the shares have been performing, or how the shares have been performing in relation to the companies in its industry. And you are able to, of course, get things like PE ratios for those companies that are profitable, and if the company that you are also researching is profitable, then you are able to compare, this company is having a PE ratio of so much compared to this one and this one and this one. Then if your company that you want to put your money in has a PE ratio of lower or way lower than those companies or average companies in its industry, then you know that it's probably a good time that maybe you go in and purchase that stock, as chances are very high that it is undervalued. I mean, that's what we are witnessing, or that's what we are sort of like seeing on Google stock, right? If you had to go and check companies that belong, or companies in the same industry as Google, you'll notice that Google stock, it is quite undervalued, as its PE ratio, ladies and gents, when you compare it to some companies in its industries or companies in the same industry, it tells us that Google's PE ratio is lower than the average of the companies that are found in its industries, which is something that must just show you that obviously then Google might be undervalued. But now for companies which are not yet profitable, you use a key term that is called obviously a PS ratio. A PS ratio is basically the market cap divided by the total annual revenues which the companies has reported. I mean, most of you already know that by now, that most companies have given us, of course, their full year 2022 earnings results, and obviously it means that then if you want to buy most US stocks, what you need to do is to check the current market cap, or take that current market cap and divide it by the obviously total revenues which that stock or that company reported or generated for the year 2022. Then obviously you do that maybe to 4 or 5 companies in the same industries, and if the company that you want to put your money in has got the lowest figure when comparing to most of the companies in its industry, then chances once again is that that company is undervalued when comparing to the companies in its industry, which is something that obviously you would then make you or help you to make a precise decision to buy that company or not. So the good thing is that all these 3 things that I was telling you, they are quite simple to figure out. Anyone, I think, can do these things. I mean, with the, of course, the total revenues, earnings per share per quarter, you get these things simple from Google, right? Especially with the US stocks. Once again, if you just go check, if you can just go and say Google stock or Google share price, then they will give you, of course, the share price or where Google is trading at. But over and above that, they can show you earnings or the financials of that company. There is a tab written earnings, which when you click, or if you have to press that button, it is going to give you sort of like the past 4 quarters or the earnings of the past 4 quarters that Google stock has been reporting, which you can just easily open. Or when you open those tabs, it will tell you the total revenues that Google stock reported, the total earnings per share, or the earnings per share that obviously Google reported for the previous 4 quarters. Then you are able to quickly analyze and check how Google has been doing. But for the companies that, same goes to the companies that are not yet profitable, you can still do that. But obviously for the PS ratio is the one that probably you just need to calculate it yourself, because PE ratios, you already know that. Again, when you say Google share price, you will definitely see that obviously it also tells you the current PE ratio. And if you already know, or if you can just click that compare button, it will tell you, or it will show you companies that are probably in Google, or some of the companies that are in Google's industry or sector, and you are able to compare the PE ratios of other companies as compared to Google. Then you are able to make a precise decision. But with companies that are not yet profitable, I just told you a trick of using a key term that is called a PS ratio, where you go take the total market cap of a stock and you divide that by the total annual revenues, and the figure that you get, you go and compare, or you try to go get the same figures in the companies or some of the companies that is in that company's industry. And if the company, or if the PS ratio of the company you want to invest in comes lower than most companies, then chances are that company, it is undervalued, which is a good thing, right? So to sum up, or to once again remind you of what you, or some of the most important things that you need to check when you are buying or before you buy a stock, is obviously the total revenues, the earnings per share, and of course how undervalued or overvalued that company is when comparing to its peers. And obviously, like I always say, there are so many ways, or there are other so many things that you can check, that you need to check the company that you want to put your money in and compare to the companies in its industry. But these 3 to me are very important that you monitor, or you monitor this, because ladies and gents, they can tell you of how the company is performing before you even go and check the overall or the full earnings statement, which obviously it's quite important. I mean, personally, I know some of the people that sometimes they don't even bother going to all earnings or full earnings results. Rather, they just check, of course, these, of course, total revenues, earnings per share, and check if whether that stock or that company managed to beat analyst expectation on what was expected in terms of the revenues they generated or the earnings per share. Otherwise, with all that, guys, I just thought I'd just give you this quick video on how you can quickly analyze a company, probably in less than 10 minutes, which is something that obviously I believe that everyone out there who is investing in the stock market can do. If you enjoyed this video, don't forget to give it that likes button, comment, and subscribe. And once you subscribe, don't forget to hit or click that notification bell so that at least you get notified by YouTube every time I drop a new content. Otherwise, that's all from me. And I wish you nothing but the best in your stock market investing journey. And God bless you all.